ever dreamed of waking up without the stress of a 9-to-5 job, knowing that your money is working hard for you, even while you sleep? What if you could live entirely off the dividends from your investments? Sounds amazing, right? Well, today we're going to explore exactly how much you need invested to make that dream a reality. Here's the 4 things we'll be covering. Number 1, exactly what dividends are. Number 2, why this works. Number 3, how to calculate how much you need. Number 4, I want to talk about a few risks you need to avoid at all costs. And by the way, welcome back to the channel if you're new here. I'm Chris White and we'll talk about all things building wealth. So don't forget to hit that subscribe button and give this video a thumbs up if you find it helpful. What are dividends? So let's dive right in. First off, what are dividends? When you invest in a company's stock, you're essentially buying a small piece of that company. Now, if the company makes a profit, it can choose to distribute a portion of those earnings back to shareholders in the form of dividends. It's like planting a fruit tree. Not only does the tree grow over time, increasing in value, but it also bears fruit that you can enjoy regularly. Or there is another way to do this that I'll share later. But first, let's talk about why this works. Now, why are dividends so appealing for retirement income? Well, dividends provide a steady, passive income stream without the need to sell off your investments. This means your initial investment can continue to grow over time, thanks to the magic of compounding. But before we get too excited, let's weigh the pros and the cons. So here's the pros of living off dividends. Passive income. Once you've built your portfolio, the income is truly passive. Potential for growth. Many companies increase their dividend payouts over time. Tax advantages. Qualified dividends are taxed at a lower rate than regular income. Inflation hedge. Dividend growth can help keep up with inflation. Now, here's the cons of living off dividends. Significant upfront investment. You'll need a substantial amount of capital to generate enough income. Dividend cuts. Companies can reduce or eliminate dividends at any time. Market risk. Your investment is still subject to market volatility. Tax complexity. Dividends can complicate your tax situation. So how much do you actually need to live off dividends? Let's break this down in 3 easy steps. So the first step is you're going to want to determine what your annual expenses are going to be in order for you to live comfortably. So for the sake of this example, I'm going to go with $50,000 per year as my annual expenses. The second step is we need to determine what our average dividend yield is. Now, you're going to be able to determine this in the research phase when you're using the aristocrats list, for example. Now, if you recall, the dividend yields on that list were anywhere from like 5% down to 1%. So for the sake of this example, I'm going to say the average dividend yield is 4%. So I'm going to put 0.04 for my 4%. And then the third step is I'm going to determine my required investment using this formula you can see here on the screen, which is very simple. I'm going to divide my annual expenses by the dividend yield. So if we do that, 50,000 divided by our 4% dividend yield, we are going to see that we will require an investment of $1.25 million to cover our annual expenses of $50,000. Yes, you would need $1.25 million invested in dividend paying stocks with an average yield of 4% just to generate $50,000 per year. But that's not the only thing to consider. Now, let's consider taxes and inflation. Taxes can take a chunk out of your dividend income, so you might actually need more than $1.25 million. Plus, inflation will erode your purchasing power over time. So it's wise to invest in companies that consistently increase their dividends. Now, for how we actually do this. So what's the best way to build a dividend portfolio? Okay, so the first thing you're going to want to do is open up a brokerage account if you don't already have one. Now, if you have one, you can obviously skip this step. If you're looking for a brokerage account, I'd encourage you to consider a Fidelity account or perhaps a Charles Schwab account. Now, if you're going to look at Fidelity, they make it really simple. You go to the homepage and you just click on here, open an account. And then you set your brokerage account up and you link up your bank account and you get it ready to start buying your dividends. Okay, I'm not going to bore you with how to set that up. It's pretty self-explanatory. The next step is you want to do some research. And what I'm going to recommend you do is you go over to Google and you just Google 2024 Dividend Aristocrats list. Okay, do a search for that, and then you can scroll down here, and what you're looking for is a list of the 2024 Dividend Aristocrats. Okay, so I'm going to click on Simply Safe Dividends here, and it's going to rank all 66 of the Dividend Aristocrats. Now, what is a Dividend Aristocrat? You can see right here, it tells us Dividend Aristocrats are S&P 500 companies that have increased their dividends annually for at least 25 consecutive years. Okay, that's the key. The dividend has increased annually for at least 25 consecutive years to get on this list. Now, what this website's done, as you can see, is made a really nice chart for us to start researching the different dividends. You can see here, there's the dividend yield. This one's at 5.84%, and then it goes down from there. I can scroll over on this chart and look at all 66 dividends to start doing my research. Okay, so I would recommend you start here. Now, the one thing I want to encourage you to consider is the inflation rate. All right, so I've got this CPI inflation calculator open, and you can find any calculator like this on the internet by doing a simple Google search. And what you can see here is there's a handy little calculator where I can put in how much has inflation gone up on average, in this case, between 2020 and 2024. Now you can see here over on the right, in the last 4 years, the average inflation rate has been 5.09%. Now, if we were to look at the average inflation rate over, say, the last 10 years, I could type in here 2014 and calculate that. You'll see it's 2.92%. We could go back the last 20 years, and we'll see the average inflation rate is 2.6%. Let's even go back the last 30 years, back to 1994, calculate that, and we'll see it's at 2.55%. So what conclusion I would draw from this data is I would consider the average inflation rate to be around 3%, to be safe and conservative as I'm calculating what I need to earn in dividend income to beat inflation. Okay, so now why is that important? It's important because when you go back to the Dividend Aristocrat list, you'll want to make sure that your dividend yield is high enough that you're not only able to beat inflation, but hopefully continue to grow your income at the same time. At least that's how I look at researching a dividend that I might want to invest in. Now, once you've figured out what dividends that you're going to invest in, it's real simple. You just go back to your brokerage account, if it's Fidelity or Schwab or whatever one you might have, and they've all got really easy ways to go in and research that dividend that you want to invest in. You just buy it, and then you collect your dividend on a quarterly or yearly basis. Now, there is one new alternative way to create passive income in the same way dividends create passive income. And what's appealing to those who use this way instead of the traditional dividend method is that it's entirely outside of the stock market, which means you don't have to stress and strain over a company's yearly earnings going up in hopes your dividend payout beats inflation enough to make it worth your time. Now, this new way that I'm referring to is called the Banker's Wealth Preservation Method. And what's unique about it is that it ties your passive income to real estate instead of the stock market. And I'm not talking about the headache of being a landlord, like most people are doing in real estate to try and make passive income. This new way is much easier, much safer, and it's push button simple. Now, chances are you've probably never heard of it because it's not widely advertised. And the reason for that is because the opportunities that surface with the Banker's Wealth Preservation Method are typically reserved for the top 1%. And that's simply because the top 1% are typically the ones with all the connections. And as you can imagine, these opportunities go fast. But if you ever do have the opportunity to take advantage of this new passive income method, it's strongly worth considering. In fact, you should know one of the big reasons the top 1% like the Banker's Wealth Preservation Method better than the dividend method is because the returns are going to be safe and consistently 12 to 15% year over year, which of course comfortably beats inflation. And as you can imagine, if you're a top 1%er, or really anybody for that matter with wealth, the last thing you want is to watch inflation eat away your earnings and jeopardize the wealth you've worked so hard to create. Now, all that being said, I don't want you to think that the dividend method is all sunshine and rainbows, even though it is truly 100% passive and hands-off for you. There are a few risks to consider, so let's talk about that. With the traditional dividend route, here are some of the key risks. First, payout ratio. Now, this is the percentage of earnings paid out as dividends. A ratio below 60% is generally considered healthy. One of the reasons over 60% may not be healthy is because, generally speaking, you want the company you've invested your money in to be reinvesting some of its earnings back into the company so it can continue to innovate and grow. Now, if the company has too large of a payout ratio, that could be a red flag for future growth. So just be careful. Second is earnings stability. Companies with stable and growing earnings are more likely to sustain dividends. So it's important you don't just look at a one-year snapshot of a company, but at least go back 10 years and see if their earnings have been stable and growing. Third, debt levels. High debt can jeopardize a company's ability to pay dividends. And fourth is dividend history. A consistent track record of dividend payments and increases is a positive sign. Again, this is where the Aristocrats list can come in handy. The last thing I'll caution you about is to avoid dividend traps. A dividend trap is a stock with unusually high yields that are unsustainable. Always prioritize the quality and stability of the company over the size of the dividend. Now, in case you're wondering, here's what I'm doing. It's because of these risks with dividends and their challenge to consistently beat inflation at a large enough margin that I personally like the banker's wealth preservation method best. In fact, I've shifted 100% of my investing strategy for retirement into this new method for 3 key reasons. First, I can count on a consistent year-over-year 12% to 15% annualized return. Second, my investment money is protected by a hard asset, which is the property, which means I can always get my money back out and never have to worry about a down year because the stock market didn't meet its projected earnings. And the third reason I like this new method is because there's always an insurance policy in my name that adds further protection from any downside risk. And all of that combined gives me the confidence and peace of mind I'm looking for when it comes to growing and preserving my wealth. In fact, as of the recording of this video, I'm bringing in $87,116 every single month from just the banker's wealth preservation method. And I'm consistently looking for more opportunities to add to that number. Now, if you're interested in learning how I can help you grow and preserve wealth by leveraging the same banker's wealth preservation method that I am using, then I check out this video here.